All right, I'm going to end on everyone's most favorite and exciting topic, taxation. What you're looking at here is a chart called the Gini coefficient. And the Gini coefficient is a statistical, empirical measure that was developed by an Italian statistician by the name of Corrado Giannini back in 1912. And the CIA used this methodology recently to take a look at the dispersion in income inequality around the world. And so 0 means perfect inequality. 1 means complete inequality. The lighter the color, the greater the equality. The darker the color, the greater the inequality. So, during the US election, you heard a lot of talk and debate about the top 1%. What does that mean? Well, the top 1% of income in Canada means your family income is $200,000 per year. In the United States, it means it's $400,000 a year, which is why you can see the US is much darker in color than Canada is. Interestingly, $400,000 also meant that to be in that top 1%, you had to at least have an $8.3 million net worth. The top 1% in Canada earns 10.6% of all the income, but they pay 21% of all the taxes. Healthcare consumes almost 50% of all provincial budgets. So a marginal tax system and those that are well off paying more taxes is as it should be, and this will help fund the huge health costs going forward. So the art of taxation. This is Jean-Baptiste Colbert, who was the Minister of Finances back in the late 1600s. And what was his job? His job was to collect the money for this guy, the biggest spender of them all, King Louis XIV, who built Versailles Palace just outside of Paris. And Colbert said, "The art of taxation consists in so plucking the goose as to obtain the largest possible amount of feathers with the smallest possible amount of hissing." So, what does plucking the goose look like today? Obama's on record, and everyone knows he's raising taxes on the rich. But what else is going on around the world? Mr. Hollande, Prime Minister Hollande. Rob mentioned France. Not sure if anyone caught the headlines recently. Anyone know the highest marginal rate of tax in France now? It was announced that it was going to be 75%. 45% in Canada. 75% in France. Now, that was brought to court, and while he wasn't successful at keeping it at 75%, it was dropped to 68%. That drop certainly wasn't enough from keeping the likes of actor Gerard Depardieu from relocating to Russia. Taxes are going up. What's happening here at home? Anyone remember the BC provincial budget? Most of you here in the room are paying 2.1% more personal income tax starting this year. On the federal side of things, what's going on with federal taxes in the budget? This is our Minister of Finance, Flaherty, and he's got his mouth full of feathers. Let's take a look at the 2013 budget. I'll sum it up. A little give, but a whole lot of take. Here's the give. The capital gains exemption, for those of you that own your own businesses, is increasing to 800,000 from 750,000, and going forward, it's going to be indexed to inflation. So we got something. Here's what they took away. Taxes on dividends from active business income under $500,000 is going up. A lot of planning opportunities in terms of using things like leveraged insured annuities and tax-efficient insurance structures. The set programs that are available, they're taking those away. There's potential new rules on testamentary trusts that are coming out. There's much more compliance that'll be coming down in terms of reporting individuals' worldwide income. And the capital class shares and the opportunity there is being removed. So what does all of that mean? The government's giving up $100 million. They're getting $3 billion. Any way you slice it, this is a tax grab. So, what you're looking at here is a compensation and analysis spreadsheet that we've used for our clients, and we've updated it for 2013 and going forward. Because a lot of you here in the room, I know, over the years, we've talked to you about the importance and the advantage of structuring your income in a way that you're taking dividends and the tax advantage that can be created from that. And while the dividend tax, taxes on dividends is rising as a result of the recent budget, we still think there's a huge, and for many of you, an advantage for doing this. But that's not always going to be the case. For some of you now, taking a salary may prove to be better. My point here is that every individual situation is unique, and whether it's taking your compensation in the form of dividends, we have tools and analysis available, and you should talk to our advisors because we have a way of looking at a number of these budget changes and planning around those that can effectively neutralize the impact that can have on each of your balance sheets. So I encourage you to take a look at that with your advisor. Let me give you a couple of examples of what I mean by some of the planning that we can do. So imagine we have a non-registered portfolio with a client of ours has a non-registered portfolio, and if it's personally held versus corporately held, well, here's the difference. Taxes on your interest, dividends, capital gains, and rents, holding that portfolio personally can be somewhere in the area of 30 to 35% over time. On the other hand, through proper structuring, perhaps considering holding those investments in your corporations, that tax can be reduced to less than 10%. Let's take a look at someone that's retired. Let's look at this fictitious couple here. They want to have a $120,000 annual income. $80,000 of that income is coming from a taxable source, $40,000 of that's coming from a non-taxable source. And through planning, they can income split. And if they do it effectively, $60,000 of income each individual will pay a total of $6,000 in tax. That's 10% tax. That's not much. That's what planning does. Even if they were to increase and double their income from $120,000 to $240,000, the total amount of combined tax that they'll pay is 15%. And I think that's very reasonable. How do they do this? Well, perhaps using prescribed annuities in terms of bonds, dividends, and holding those dividends in the right place. We all know that dividends are taxed at a much lower rate of taxation than interest. Rental income and where you hold that and structuring that effectively can be very tax efficient. And of course, effectively splitting the income with the use of trusts, RIFs, and holding companies. Let's look at an estate planning example. Let's look at this fictitious couple and assume they have a $2 million home. They have $750,000 of recreational U.S. real estate. They have $1 million in insurance assets. They have $2 million in their holding company, and they have $1.5 million spread across either their RRSPs or their RIFs. If they don't do any planning right now, they're looking at total tax, income tax, probate, U.S. estate tax, capital gains on disposition of the last to die of $1.5 million. Through planning, perhaps the use of alter ego trusts, estate freeze, a donor-advised fund in terms of charitable giving, taking a close look, given all the changes with U.S. rules on where and how that U.S. asset is owned, and lastly, effective use of insurance, that tax can be brought down to that tax bill can be brought down to $150,000. That's what effective planning can do. All right, my last breath and check coincide. Speaking of last breath, I'll make this my last breath. Without proper planning, let's look at this scenario. Look, my son, one day you shall inherit all of this. Years later, your father left you his pipe. I encourage all of you to take the opportunity, especially in light of tax changes and what we see going forward, to speak to your advisor and take a close look at your situation. I want to take this moment to thank all of you for listening to myself and Rob and Jason this evening. And with that, I'm going to pass it back over to Jason to close with a few housekeeping items. Thanks very much, everyone.